So the way I look at gold is it's a store of value. You look at what's significant that's really happening this year is there's been a profound amount of ETF outflows. And something I was just starting to look on is since gold ETFs peak right around this October 2020, total ETFs in gold have dropped 26%. Yet over that same time, the price of gold's up 14%. That's never happened. Now, we've had 20 years of history now since GLD was launched. It's never happened. And I've been pointing this out for quite a while. So that's a sign of divergent strength in the metal. So why is gold going up? Well, the deepest pockets on the planet, central banks are buying gold. And the number one suspect, according to the World Gold Council, is China, not just the Chinese central bank who can print fiat currency and buy the metal, but Chinese citizens.
Gold prices have remained relatively stable, hovering above the $2,150 level as the European session unfolds on Wednesday. Mike McGlone, senior commodity strategist for Bloomberg Intelligence, notes that despite outflows from gold ETFs, the price of gold has continued its upward trajectory. Central bank purchases, particularly from China, have been identified as a significant driving force behind this trend. Interestingly, McGlone highlights a departure from historical patterns, pointing out that while central banks actively accumulate gold reserves, they are not doing so for silver. Looking ahead, gold demand is expected to experience a lull in the coming months. After the robust gold buying season in China during the first 2 months of the year due to Lunar New Year demand, March and the second quarter typically witness lower consumer activity. However, anticipation is building for a resurgence in Indian gold imports and demand leading up to Akshaya Tritiya in early May. This auspicious festival typically boosts the local market premium over the LBMA price as wholesalers restock in preparation. Meanwhile, silver has faced selling pressure for the second consecutive day, retracting further from its year-to-date peak around the $25.45 region touched last week. McGlone suggests that while gold's upward trend may support silver prices, broader economic conditions, including the potential recession in China, pose significant challenges to silver's performance. The significance of China's appetite for gold extends beyond mere investment diversification. McGlone highlights how geopolitical tensions and decisions made by world leaders, such as the evolving relationship between China and Russia, can profoundly impact the commodities market. For instance, Russia's recent pegging of the ruble to gold underscores the role of precious metals in stabilizing currencies and the potential repercussions across global markets. Join us as we delve into insights shared by Mike McGlone. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I published that just a couple days ago. That gold versus all the metals is crushing. It's melting the metals. It's agriculture is melting versus gold, and energy has got no chance. Just humans create more energy every day. We can't really create more gold. But the gold silver cross, yeah, that's a recession. Basically, gold and the whole commodity space is a clear recessionary trajectory at the moment. So you look at gold on a 1 year basis. It's just year to date. I mean, but gold in 1 year basis is up like 20% or so. And most commodities are down. We've had a little pickup recently with copper, but industrial metals are down. Energy is picking up recently, but the overall bent, and certainly from a gold silver standpoint, is towards a global recession. And then it also makes sense, clear sense, like I mentioned earlier on. It's that paradigm shift that what happened with President Xi's unlimited friendship with President Putin. It's just, to me, still shocking that I think history is going to look back at and use some American vernacular and say, dude, what were you thinking? It's just shocking. I mean, the amount of get me out of there that I see from China is just amazing. And it should, because like I said, it created this axis of five bad guys. It just solidified it. So from a silver standpoint, silver is much more of an industrial metal now. It's been demonetized by gold forever. It's stuck in that range between 21 and 26, bumping up near the upper end, as it should be, because I think gold is pulling things up. But it's got the problem with, I think, with platinum and palladium and even copper, is if China is going to have a pretty deep recession, a depression, which I think they are, that country is completely dependent on fiscal and monetary stimulus. It's way overdue for just a normal reversion of rapid economic growth. And what better way to trigger an implosion, or it's like just a correction, a reversion of rapid economic growth, than to piss off your best customers by quasi supporting the war in their backyard. Come on, it's just seriously silly. But that's where things are. So as a strategist, I just have to point out where things are going. And silver stuck in with the industrial metals. Gold, by the way, and I like to end with this: central banks aren't buying silver. a growing global economic environment typically usually have emerging markets and rest of the world doing well, which include China, and maybe their currencies doing better and dollar weakness. Silver outperforms that environment almost always a gold. We're not. Let's look at the tilt here. We're still tilting towards GDP estimate revisions heading lower for most of the world. Hopium that China will recover. Hopium that Canada and England and well UK and most of Europe and Germany and Japan will recover. Yet only China started cutting rates, and even Japan might start hiking rates. So as far as cycles are concerned, it's not the right time to expect that. So I look at it as good luck. I just look at by the end of this year, and we have this election in this country. I would love to be able to see that organic demand pool growth in the rest of the world. That would be benefiting for silver right now. The U.S. is the only shining star, and the way I really look at it, Tom, is the best measure of the U.S. shining star is the U.S. stock market. It's the highest ever versus the rest of the world stock market values. Data is back 60 years on that. If you just measure it versus MSCI ex-US index, just a little reversion on that, and the Dow will tumble. And silver is much more in that camp with crude oil and copper. And that's what I really appreciated just publishing my gold versus everything else outlook to just point out how it's not only the enduring metal, but it looks like it's at a stage right now is if we get what I think we're going to get this year, it's just a normal pendulum swing back from that. Remember a year ago it was completely recession in this country, and then it was complete soft landing. Well, we got that. Now, if you just tilt back a little bit, the stock market is coming back a little bit, which it always does. That's I'm worried about the iterations on the back of that.
Amidst robust U.S. growth, substantial job numbers, and persistent inflation, the Federal Reserve appears hesitant to consider immediate interest rate cuts, with some analysts arguing that more measures are necessary to rein in inflationary pressures. However, Chair Jerome Powell indicated during his congressional testimony on March 6th that the Fed believes the current policy rate is likely at its peak for the tightening cycle, suggesting a pause in rate hikes. Mike McGlone notes that despite inflation surpassing targets and speculative bubbles in various asset classes, further monetary easing by the Federal Reserve seems improbable. In December, the Fed forecasted 3 25 basis point rate cuts for 2024, with an additional 100 basis points of cuts expected in 2025. McGlone expresses skepticism regarding the Fed's ability to effectively address inflation and asset bubbles simultaneously, particularly given the risks associated with excessive monetary easing. Let's get back to the interview.
If you delay the volatility, delay the inevitable, as Jesse Livermore said, the great speculator said, markets will always do what they should. It's just a question of when. There's two main reasons. Number one reason was what is wrong with $1.6 trillion of GDP growth that costs $2.5 trillion, about that, of fiscal deficit spending? It was about 6% or so on the gross basis, the most ever outside of a recession or war. Well, that's a problem. Okay, we're goosing the economy with deficit spending and the wealth effect. I mean, just to look around, the average home value in this country has doubled in 10 years. I'm in Miami. You see condos have doubled in less than that. People feel wealthy. And the stock market, was able to recover, so people feel wealthy. And to me, those are the key facts that I'm afraid of the inevitable will be happening. And the more you delay it, the higher you go, the worse it's going to be. And that's where I'm really worried about this breakout that's kind of sucking everybody into risk assets. Is going to stop them out. And I sure hope it doesn't. But that's why I said it's not profound to say we haven't had a 10% correction in the S&P 500 in a while, and it's not profound to expect that to happen and to see how markets react. And that's where I think that's going to be the big test. And I expect gold and treasury bonds to come out ahead. So it's, to me, the key fact is it's very it's almost silly to expect the Fed to ease with inflation about double their targets and ticking up lately, which I think is just following intangible assets, stock market and the wealth of it going higher. And with this, this massive speculation in the highest prices ever in cryptos in the stock market. It's silly to ease in that environment. It's just too risky, particularly when their mantra is to avoid the inflation we got by easing too much. So to me, that's the lose-lose. The market, I don't think the Fed's going to ease until the market tells them. Market's got to go down to do that. And that's just my views. Hopefully we get out of this, but it's showing up every single time the stock market makes new highs. I love to watch Fed fund futures in 1 year. What are they predicting for cuts? It's down around still at 100 basis points. The first time in this cycle that Fed fund futures in 1 year started pricing for 100 basis points in 1 year was at the start of 2023. And the Fed hiked 100 basis points in 2023. Oops. So markets have been wrong there. And they're still wrong. The expectations for easing. 4 years ago, when there was a risk that we were all going to die, we pumped up liquidity, the greatest liquidity pump in history, bar none. The only comparison I like to go back and compare was to the 1920s, the late 20s in the U.S. And then we all saw what happened. And you know how that ended? It ended with the debasing of the currency. We took, that we just confiscated the gold and said, well, sorry, we're not going to give you $20 an ounce, and it's worth $35 an ounce a couple months later. So that bottomed everything. I hope we're not going to go there. But the point is, right now, I like to use this. The world, there's a completely, almost exceptional, inordinate burden that the U.S. stock market has to keep going up just for things to stable. If it just has this normal pullback and correction, to me, that's a great test. I'm waiting to see how. A wonderful thing for investors is there's alternatives. T-bills, 5% lock in for a year. And for traders and from the more tactical oriented, these are tremendous environments. And right now, volatility is exceptionally low. So I forgot to mention the VIX. If you take the VIX volatility index minus T-bill rate, that average, like the last 20, 30 weeks, is the lowest since 2006. That's when I first started getting signals that we're going to have some volatility reversion, and we got the great financial crisis.
Given the Federal Reserve's hesitancy to consider immediate interest rate cuts, despite persistent inflation, what implications do you anticipate for the broader economy and financial markets moving forward? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.